$313, $215, $309, $49, $116. 5 well-known dividend stocks all sitting at 52-week lows. Combined, they've paid uninterrupted dividends for over 150 years. In this video, we're going to look at each one, the price, the reason it's down, the dividend track record, the buybacks, and what $10,000 invested would project to over the future. By the end, you'll see how just $10,000 in one of these is projected to grow over $797,000 and pay you over $6,000 a month in dividend income. But let's start with the one that's basically already at the bottom, $49.63. That's the current price of Main Street Capital. The 52-week low is $48.95. So we're talking about a stock that's barely $1 above the lowest price of the year. Now, here's the thing about Main. It's a business development company, which is a fancy way of saying it lends money to small businesses and collects interest. And when the market expects interest rates to drop, the income these companies make drops as well. That's the reason Main is down. Not a business problem, a rate problem. But if you look at the actual dividend history, this company has never reduced its regular monthly dividend. Not once, not in 2008, not during COVID, not now. In fact, they've raised their dividend every single time since their October 2007 IPO. That's 18 straight years of paying and increasing dividends. And last month, the board raised the monthly dividend again by 1.9%. The yield right now sits at 8.7%. Here's the part most people miss when they look at Main. The lower middle market strategy isn't just about lending. They also take equity positions in some of these companies. In January, Main fully exited its investment in KBK Industries, a Texas-based tank manufacturer they first backed in 2006. The equity stake, just $700,000 in original capital, produced $17.3 million realized gain plus $25.1 million in cumulative dividends over the holding period. That works out to 62.7 times their money on the equity, with a 127.2% annual rate of return on one investment. A quick note on buybacks. BDCs don't really buy back shares the way Coca-Cola or a Sherwin-Williams would, where they issue equity to fund the new lending. That's just how the model works. What Main does instead is run an absurdly efficient operation. Operating expenses to total assets sit at 1.3%, among the lowest in the industry. Non-accrual investments are only 1.2% of the portfolio. The credit book is clean, and they're holding $1.4 billion in cash and unused credit. If you look at the underlying numbers on Main, you get an 8.7% dividend yield, a 3.71% dividend growth rate, and a 4.66% annual share price appreciation. Highest yield on this list, lowest growth. So if you put $10,000 into Main Street Capital today, the projections show this. Year 1, the account would sit at $11,336. By year 10, $33,937. By year 20, $107,666. And by year 30, the balance would reach $321,147. In year 30, that $10,000 would be projected to pay out $19,041 a year. That's $1,587 every single month. Out of the $311,147 total value added, $123,442 comes from share price appreciation, and $187,704 comes from reinvested dividends. The dividends do most of the work. Main is the income engine of this list. The next one is not an income story. At number 4, we have Sherwin-Williams. Sherwin-Williams just finished buying back $16.58 billion worth of its own stock. 106.98 million shares retired over the life of the program. And then, right after the buyback completed, the stock fell to a 52-week low. Current price, $309.08. The 52-week low, $294.32, so we're about 5% above the bottom. The reason Sherwin-Williams is sitting here is housing softness. Paint sales depend on home sales. When people move, they paint. When home turnover stalls, paint demand stalls with it. On the Q1 earnings call, management actually shifted full-year volume guidance from growth to a low single-digit decline. They're getting it done on price, not volume. And the consumer brand segment, that's the DIY side, is the weakest spot in the entire business. But here's what people miss about Sherwin-Williams. It owns its distribution. Over 5,000 company-operated stores across the U.S., Canada, Caribbean, and Latin America. That's a vertically integrated model. They don't just make the paint, they sell it directly to the contractor walking in the door. Nobody else in the industry is structured that way at scale. Q1 2026 sales hit $5.67 billion, up 7% year over year. Net income was $534.7 million. Gross margin actually expanded by 90 basis points despite the soft demand environment, and full-year EPS guidance was reaffirmed. The company also runs 3 segments: Paint Stores Group, Consumer Brands, and Performance Coatings. That last one, Performance Coatings, is the industrial side. We're talking coatings for cars, planes, factory floors, which means even when the housing market is dead, that segment keeps generating revenue. On dividends, Sherwin-Williams is a dividend aristocrat, 47 consecutive years of dividend increases, 3 years away from dividend king status. Annual dividend is $3.20 per share. Yield is just 1.04%. And that's an important detail. SHW isn't really an income stock. It's a total return stock. Which brings us back to the buyback. In the first quarter of 2026 alone, Sherwin-Williams spent $575.6 million buying back shares at an average price of $359.72. In the first quarter of 2025, they spent $351.7 million and returned $773 million total to shareholders in that first quarter. The remaining authorization sits at 28 million more shares. So if you look at the total shareholder return picture, dividend plus buyback, the yield you're effectively getting is much higher than the 1.04% dividend yield alone suggests. The buyback is how they return cash. The dividend is the cherry on top. Run the numbers on Sherwin-Williams, and what shows up is a 1.04% dividend yield, a 12.19% 10-year dividend growth rate, and a 12.22% annual share price appreciation. That's what total return looks like. The projection on $10,000 in Sherwin-Williams? Year 1, $11,326. Year 10, $34,731. Year 20, $120,588. And by year 30, $418,579. Annual dividends by year 30 would project to $3,811, about $318 a month. Like I said, Sherwin-Williams isn't an income story. Out of the $408,579 of total value added, $376,730 comes from share price appreciation. Only $31,849 comes from reinvested dividends. SHW makes money on growth, not yield. Okay, 2 stocks down, 3 to go. And in the end, I'll show you a 52-week low stock that's projected to turn $10,000 into nearly $800,000, paying over $6,000 a month in dividend income. But first, let's look at number 3, and this one might surprise you. Now, this one's going to look a little out of place at first. Stay with me. Current price, $116.55. The 52-week low, $106.06, down 27% from a high of $159.55. NetEase, NASDAQ ticker NTES, a Chinese internet and gaming company on a U.S. dividend stocks list. The reason NetEase is at a 52-week low has almost nothing to do with NetEase itself. China tech sentiment in 2026 is brutal. The whole sector is being avoided over geopolitical risk, U.S.-China tensions, and the legal structure that Chinese ADRs use, something called a VIE structure. Investors are nervous about all of it. On top of that, the dividend itself looks strange to a U.S. investor. In the fourth quarter of 2025, NetEase paid $0.232 per share. For the first quarter of 2026, paid in June 2026, they're paying $0.144 per share. That looks like a 38% cut, but it isn't a cut. It's the policy. NetEase's dividend policy is variable by design. Each quarter's dividend is set based on that quarter's net income. So when earnings are strong, the dividend is bigger. When earnings normalize, it comes back down. The 10-year dividend growth, CAGR, is still 22%. It goes up over time, not just in a straight line. Now, here's why this stock belongs on this list. NetEase has $24.3 billion in net cash on its balance sheet after subtracting all debt, for a company with a market cap of roughly $74 billion, which means about 1/3 of the entire company is just sitting in cash. First quarter 2026 revenue came in at $4.4 billion, up 6.1% year over year. Gaming revenue alone was $3.7 billion. The two big global releases, Marvel Rivals and Where Winds Meet, are working. Where Winds Meet has crossed 80 million cumulative players. And while everyone fixates on Chinese ad regulation, over 80% of NetEase's revenue comes from games, not ads. That's $3.7 billion of $4.4 billion total, verifiable straight from the first quarter filing. Which means the company is far less exposed to the kind of regulation that's been hammering Alibaba and Tencent. Price-to-earnings ratio is around 15. For a profitable, growing, cash-rich gaming company that just generated $1.5 billion of net income in a single quarter, that's cheap. Now, here's where the projection gets interesting. NetEase's 10-year dividend growth rate is 22.04%, highest on this list by a wide margin. But before I run the math, I need to be honest with you for a second. A 22% dividend growth rate held for 30 years? Well, that's unrealistic. No company has ever sustained that kind of dividend growth that long. Not Coca-Cola, not Apple, not anyone. And given that NetEase's dividend policy is variable, like the quarter one cut from $0.232 to $0.144, proving that, projecting 22% compounding for 3 decades wouldn't be a projection, it would be a wild fantasy. So for this video, I'm cutting the dividend growth assumption almost in half, from 22.04% down to 11.92%. That's NetEase's projected dividend growth rate for the next year. A conservative number, the realistic version of NetEase's dividend story over 30 years. Now, with the metrics, a 2.55% dividend yield, an 11.92% adjusted dividend growth rate, and 13.5% annual share price appreciation, here's what $10,000 looks like over 30 years. Year 1, $11,605. Year 10, $43,645. Year 20, $184,818, and by year 30, the balance would reach $762,646. Annual dividends by year 30 would project to $10,646 or $887 a month. Out of the $752,646 in total value added, $665,037 comes from share price appreciation and $87,609 comes from reinvested dividends. $762,000 from $10,000, even with a conservative dividend growth rate. That's what NetEase looks like. The next stock doesn't need any haircut on the math. It's been raising its dividend for 62 straight years. What does the worst housing market since the financial crisis actually look like for a dividend king? Lowe's CEO Marvin Ellison used that exact phrase on the first quarter earnings call, the most difficult housing market since the financial crisis. Current price $215.03. The 52-week low, $208. That's about $7 off the bottom, down 27% from a high of $293. Here's the thing about Lowe's versus Home Depot. Lowe's is structurally more exposed to DIY. About 60 to 65% of its revenue comes from the do-it-yourself customer, the homeowner painting the bedroom themselves or installing their own backsplash. Home Depot leans more on the pro, so when the consumer pulls back, Lowe's feels it more. On top of that, in the first quarter, the company recognized $96 million in pre-tax expenses tied to two recent acquisitions, Foundation Building Materials and Artisan Design Group. Margins compressed, and the stock dropped about 3% the morning after that Q1 earnings beat. But if you look at the actual Q1 numbers, the picture's different. Sales came in at $23.1 billion, up 10.3% year over year. Adjusted EPS hit $3.03, up 3.8% and ahead of estimates. Online sales grew 15.5%. And those two acquisitions, FMB and ADG, they just opened up a $250 billion market in new home construction and multifamily. Lowe's had previously generated zero revenue from that segment. The company estimates the U.S. will need roughly 12 million new homes by 2033. Lowe's now has a way to capture it. On the dividend side, Lowe's is a dividend king. That means over 50 consecutive years of dividend increases. Lowe's specifically is at 62 years and counting. The current dividend is $4.80 per share annually. Yield of 2.23%. Payout ratio sits at around 40%, so there's plenty of room for the dividend to keep growing. On the buybacks, Lowe's has been buying back shares aggressively for years, multi-billion-dollar repurchase programs. The pace slowed slightly in 2025 and 2026 to finance the acquisitions, but the buyback engine is still running. On Lowe's, the metrics tell a slightly different story. A 2.23% dividend yield, a 15.67% 10-year dividend growth rate, and 11.55% annual share price appreciation. The dividend growth number is the highest of the three housing-exposed stocks on this list. If you check the math on $10,000 invested in Lowe's, here's what the projection looks like. Year 1, $11,378. Year 10, $37,866. Year 20, $161,102. And by year 30, the account would reach $813,975. Annual dividends by year 30 would project to $49,295, about $4,108 a month. Of the $803,975 in total value added, $533,904 comes from share price appreciation, and $270,070 comes from reinvested dividends. Strong number, strong story. But there's one more stock on this list, and on the income side, it has an even stronger story. Of all the stocks on this list, Home Depot has paid out the most money to its shareholders in the last 12 months, $9.2 billion in dividends in fiscal year 2025. $9.2 billion. And the stock is sitting at a 52-week low. Current price, $313.07. The 52-week low is $289.10. So we're about 8% off the bottom, down 27% from the 52-week high. And the reason is simple. Housing. Recently, Home Depot reported its first quarter fiscal year 2026 earnings. CFO Richard McPhail described the environment as a broken housing market. Mortgage rates stayed higher for longer than anyone expected. Existing home turnover sits at multi-year lows. And when nobody moves, nobody redoes the kitchen, swaps out the floors, or repaints. Small projects under $1,000, well, those are still happening, but anything bigger, that's where the slowdown is. Now, here's what most people miss. The business itself is not broken. Quarter one sales came in at $41.8 billion, up 4.8% year over year. Comparable sales rose 0.6%, positive comps in the worst housing environment in years, and full year 2026 guidance reaffirmed at 2.5 to 4.5% total sales growth. If you look at the footprint, 2,361 Home Depot stores, plus over 1,280 SRS distribution locations, over 470,000 employees, they're still gaining share with professional contractors. On the dividend side, Home Depot has paid a cash dividend for 156 consecutive quarters. That's 39 straight years. The current annual dividend is $9.32 per share, yield of 2.98%, and they raised it again earlier this year by 1.3%, even with the earnings declining. But here's the most interesting part of Home Depot's capital allocation in 2025, the buybacks, or actually the lack of them. Home Depot's official capital allocation order is simple. First, reinvest in the business. Second, pay the dividend. Third, return excess cash through buybacks. In fiscal year 2025, they spent $9.2 billion on dividends and zero on buybacks. Why? The SRS distribution acquisition added significant debt, around $56 billion in total. So management chose to pause the buybacks until leverage normalizes. That's expected to happen in the first half of 2027. So in plain English, when Home Depot had to pick between one of the two ways to return money to shareholders, they chose to pay the dividend and stopped buying back stock. That's about as strong a signal as a company can send about how significantly it views its dividend. Home Depot's investment math blends out to a 2.98% dividend yield, a 14.14% 10-year dividend growth rate, and a 9.07% annual share price appreciation. The yield is modest. The dividend growth is what does the heavy lifting over the long run. The projection on $10,000 in Home Depot: Year 1, $11,205. Year 10, $33,436. Year 20, $138,034. And by year 30, the balance would reach $797,562. But the balance isn't what makes Home Depot the climax of this video. The income is. Annual dividends by year 30 would project to $82,039. That's $6,837 every single month from a $10,000 starting investment. Of the $787,562 in total value added, $378,150 comes from price appreciation, and $409,412 comes from dividends being reinvested. The reinvested dividends actually did more work than share price appreciation. Question: what if you don't have 30 years for your investments to compound? What if instead you want to retire on Fidelity Index funds in 20 years, maybe even 10 years, all starting at zero? I ran the math on all three timelines, and that video is on screen right now.